And thank you for attending this session, the Cyber Creep. My name is Paul Miskovich. I'm the moderator for this panel. The panel will examine two issues that are really growing in the cyber community. The first issue deals with cyber coverage and finding it in non-cyber forms. The panel before us, immediately prior to us, Bob Parisi, said it's his recommendation that perhaps risk managers and insureds should buy cyber coverage because they might need it, because as cyber coverage may not be readily available or may not be included in some of the other policies. The second topic we're going to cover is cyber aggregation creep, which is a growing issue for insurers as we take a look at how interconnectedness of data and systems is causing aggregation risk, both on the insurance and reinsurance level. So I'd like to start with a quote from Insurance Day. One lesson from the history of U.S. asbestos and environmental coverage litigation is when many policyholders are affected by a major new form of liability. The pressure builds on courts to find coverage under policies that were not intended to provide it. Where are they looking? Are they finding coverage? And how are insurance companies responding? So let's first introduce the panel and give them a chance to answer the question. To my left, I have Jack Kincaid, a partner at the Washington, D.C. office of Cipriani and Werner. I have Richard Bortnick with the law firm of Traub, Lieberman, Strauss, and Shrewsbury. I have Jason Glasgow, a cyber risk product manager with Travelers, Bond, and Financial Products, and Brian Thornton, president and owner of Pro Writers and MGU and Wholesale Brokerage. So to start off the panel, let's go with the first question, really dealing with policyholders without cyber coverages. So I'd like to talk about what types of policies and coverage provisions have the courts had to review to determine the existence of cyber coverage, and how have they decided? So Rick, why don't you jump right in?
All right, well, I think the most obvious type of policy is the CGL form, personal advertising injury. And that's where we've seen most of the litigation in this area. You know, people talk about cyber this, cyber that in terms of litigation. Virtually all of it, with limited exception, is in the CGL area, and specifically the personal injury area. It has to be a publication of a defamatory statement or something that invades privacy. And the cases, the Sony case, I'm sure you're all aware of the PS3 breach, where a bunch of allegedly anonymous hackers broke into the PS3 system, shut the programs down for a month, and the court there said that there was no CGL coverage. And then you jump ahead to a case called Recall Total. Court there said there's no coverage because there was no publication. And then there was a separate case that went the exact opposite way. And the Sony case came down, said there was publication, but not by the insured. It was by a malicious third party. You have the same thing in the kidnapping and ransom, or the theft. You have Retail Ventures versus National Union, where you had a crime policy respond. So you've got various types of policies, as Paul said, that were never intended to respond. It's not that they weren't intended. Cyber wasn't even contemplated when these policies were being written. A lot of these are ISO forms, some of them are manuscript, but when people were looking at this, even as late as 2001, 2002, cyber was not even a bubble in people's minds. You know, Bob Parisi may have known about it, but not most other people did, so I think that's a short answer. You have E&O policies, you've got D&O policies, all these other types of forms that professional services policies. You need professional service, you need some form of negligence typically, but they have to be tied to the security type event. And a lot of our writings are miscellaneous and our professional involve security type companies, especially technology companies. And a lot of companies think they have coverage, like lawyers, for example. As a lawyer, you know, it took me a year and a half to convince my old law firm to buy cyber because they were being told that everybody but me would tell them that their professional liability policy would respond for cyber. Well, it might respond for third-party claims, but didn't respond for first party. It wouldn't respond for crisis management. And who wants to eat their E&O tower by paying a cyber claim? Because when you got 500 lawyers, as we did, you've got E&O concerns you have to worry about that are way beyond cyber. So it runs the full gamut across the board.
So is there, is it just the GL, or are there other policies that, when you look at them in the totality, one can conclude that there's enough coverage from a traditional insurance buyer perspective that they don't need to buy cyber insurance?
I think that no policy provides the type of coverage, the consolidated coverage that the cyber policy does. You've got the first party, so you could buy a first party property policy which only covers tangible property, maybe get an endorsement for intangible property. Good luck getting that, but maybe you'll get it. You could buy a third party E&O, D&O, as I say, but you wouldn't have first party, you wouldn't have crisis management. And then crisis management, which is the vendors, the John Mullins of the world, the Ron Rathers of the world, you don't get them under any other type of policy but cyber. So you get the three necessary coverages under cyber, one of which isn't available anywhere else, and the other two, by the time you're done paying for your property and your liability, you may as well just get a cyber and have the crisis management thrown in.
Thank you. So are there any coverage issues that the courts have been struggling with? I know, of course, there's the Sony issue involving publication. Have there been any recent court decisions pushing on the arguments that are being made?
You want some help?
No, well, I thought
You don't need it.
No, I don't need it. Well,
I'm the luckiest man in the world. I'm sitting next to the guy who has a dozen years of experience doing this.
I don't monopolize the panel. You flew all the way out here from Washington.
I did, just for you.
Thank you very much.
Yeah, and what we experience on the
I am the
litigation...
cyber creep, by the way, just for the record. So they nominated me as the lawyer.
A couple of additional points that we see as a litigation firm. Plaintiffs find a way to become very creative. And in the absence of express language in the existing policies that they hold, then they go policy or claim searching, which includes the D&O and the E&O. And they try to raise a standard of responsibility on the part of the corporate entity. And if the company that has permitted the breach to occur because they have not satisfied adequate standards, the plaintiff's bar will try to find as many different avenues into the court as they possibly can. That's the bad news, but the good news on the defense side is at least we have seen, and as we monitor the cases, that the courts are still relying on traditional methods of looking at coverage issues. And this is where we as a law firm, we are really a very early adapter on cyber insurance because we did our full coverage audit and we said we can't run the risk, and we deal with a lot of risk managers, so we wanted to try to practice what they preach to us. So we got cyber coverage early on, and it's a policy that has, I think, served us well, and we're able to point that out to others when we're advocating for cyber coverage. Our focus is to work from the courtroom back. We want to be able to get the case dismissed. Everything we do is kind of defense exhibit A. So to the extent we can get the proposed insured positioned properly so that they are a good qualified candidate when the brokers meet with them and then when the policies are issued, we find that to be the best way to approach it. The courts will become more liberal, and we're starting to see a little forum shopping right now. You've got the 7th and 9th Circuit that are fairly liberal and are allowing standing contemplative damages as opposed to actual damages, and the 1st and 3rd Circuit are still kind of towing the line on traditional precedent. But we would expect that to loosen up a little bit as time passes. So as you're considering the cyber policy, the best way, of course, is to have that specific coverage. And our kind of caution to our clients is if you're writing a standard policy, those who want the insurance know what you're asking for so that the carrier and the broker can put it together for you, get the right endorsements, avoid the exclusions that you don't want. So that is very, pardon me, so it's very easy for the courts then to see what was intended by the parties, what was contracted for, and in whether it's the coverage that they need, and for us as a trial lawyers, that we can prevail on behalf of our insurance clients.
And I think Jack made a really good point, Paul, that the underlying cases are really driving the need for coverage and the efforts of policyholder counsel and brokers to find alternative coverages for the cyber areas, because class actions now are getting past the motions to dismiss, as Jack said, on standing and damages grounds. The threat of future harm is being considered by the 7th and 9th Circuit sufficient to get past motions to dismiss. The Supreme Court is going to hear this term, actually, in I think it's Fair Credit Reporting Act case, whether actual damages are required in the statutory context, but hopefully it'll instruct the lower courts on the cyber type area where you're dealing in common law, not statutory. So we might get guidance, but in the meantime, the defense costs, the lawyers' fees are what drive it all. Yay for the lawyers, but they're making lots of money, and the plaintiffs' lawyers are making more money than the defense lawyers, and then the insurers are paying for it all.
So let me ask this question to Jason and Brian. So how are insurers responding with products and exclusions, and what is the result or impact? Because we're talking about an increase of courts being willing to find coverage in the GL, in a professional policy, in a crime policy, in perhaps in D&O policies. From a broker's perspective and underwriter's perspective, what do you see happening in the marketplace?
So one thing that insurance carriers are good at is taking a look at risk and how it's spread across all of our insureds, and then pricing for the exposure that they have. Right. That's the basis and foundation of insurance. So as different coverages come in place in policies that weren't intended to cover those things, and GL, crime, those kind of policies, carriers take a look at that and say, holy crap, we didn't intend to pay those claims. So then we figure out a way to price for that exposure in a different way. So when you start to see exclusions on the GL policy, there's the ISO exclusion for GL. When the National Union case came out on the crime policy, everyone who writes crime looked at their policy to see how they can not cover those claims there. So we're really trying to, as an industry, is price for the exposures that our insureds have and kind of bucket it into the cyberspace. So we don't have that miscellaneous exposure on the GL, the D&O, the E&O, the crime across the board. We can bucket it into a priced for product in cyber. So I think that's where we're moving. We're starting to see, you already have the GL exclusion. We're starting to see D&O exclusions. It's pretty in the infancy there, but in the healthcare space, we're seeing some exclusions on D&O. Haven't seen exclusions on E&O quite yet on that. But so we're starting to see that industry shift toward exclusions.
I've seen some exclusions recently, endorsements in manuscript forms.
Yeah. And that's typically coming from the carriers that offer standalone coverage so that they can then offer that separate policy.
Yep.
Whereas I see a lot of the carriers that don't have any sort of cyber capabilities but are maybe doing an E&O line are intentionally vague on it because they're trying to have that kind of gray area. And as a broker, nothing makes me more uncomfortable than having gray or uncertain language. I'd much rather something explicit. And so going to the lawyer's argument, I just had an argument on Monday with an attorney who said the exact same thing. Well, isn't that covered under our E&O? And so this kind of brought us back to a conversation of where it's going.
I read 38% of risk managers and policyholders think that their GL covers cyber, 38%.
Yeah.
And that's a big number.
Yeah, and so as far as the changes, unfortunately what I still see is a lot of the same. A lot of carriers still not willing to add the exclusion, whether it's a GL policy or otherwise, and they want to be vague because they don't want to be the carrier making the move and then that being used against them. And I think it'll take case law or specific large claims to really kind of move that needle. And so one of the examples we were talking about when we got started was 10 years ago, and I won't use any names, but I had a meeting with a large broker, a whole team of them doing lawyers' business. And from the carrier perspective, we walked in and their assertion was, well, this is covered because it's not excluded. And the carrier said, well, we have a separate policy for that. It asks 100 questions. We don't ask any of them within this, so it's our intention that it's not covered. That was the entire meeting. They got up and left. We got up and left. It's 10 years later, and it's still the same thing on the lawyer's business. So to me, that's mind-boggling that hasn't really changed. And to me, I see that being a similar thing on some of the other lines as well.
So what do you think is going to be the timeline for some sort of a transition?
I think you're already seeing the timeline, right? So we're already seeing that transition going. As we look at, I was having a discussion yesterday over dinner about the premium in the cyber business and the losses in the cyber business. We talk about the estimates are $2 to $3 billion in premium right now, and then you look at just the five, think of the five biggest data breaches that you can think of off the top of your head. Just those carriers spent $500 to $600 million. So just on those 5 claims, that represents 25% of the premium in the business. So yes, we're paying losses, and yes, we want to make sure we're pricing for that exposure adequately. So I think we're starting to see we don't want to pay that under the D&O, the E&O, and the crime, and the property, and the GL, right? So that transition has already started.
Great. So I have to ask a question for Rick, because he made a statement that said 38% of risk managers believe that they have coverage.
GL coverage.
GL coverage covers
For cyber.
Okay. So I guess the follow-up to that is there any case law out there that you could point to, for the brokers in the room, and just say, okay, you need to explain to your risk managers what this case law is and how it works and why there's no coverage?
Yeah, well, the Sony case, the recall total case out of Connecticut. I mean, those courts explicitly said on those facts, and let's face it, facts really dictate the results, but the courts on those facts said there was no GL coverage, no personal injury coverage. And the other thing that I advocated when I was trying to convince my old firm to buy it was, we don't want to suck down our third-party limits. You have 500 lawyers, as I said. You've got E&O claims, whether they're valid or invalid. You need the limits because defense costs erode the limits, and you want to keep the tower as big as you possibly can for those claims. And most importantly, there's no crisis management. And a lot of buyers, we were talking in the panel before this one, why do people buy cyber? Small companies buy cyber, not for the insurance, but for the crisis management pre- and post-breach. So, that is a feature of cyber that you're not getting anywhere else. You're not going to get the breach coaches. You're not going to get the pre-breach counseling in any other product line. So if I'm a broker, I'm trying, and the pricing is so low. I mean, the pricing is ridiculously low. We were talking about 5% online for excess markets, like for an $80, $90 million attachment points. It's almost free when you think about it in context of other types of products.
The takeaway from this panel is not that it's free. I just want to clarify that.
Yes, I'm speaking on behalf of travelers in saying that.
I think Rick's got a good point. I mean, there's a big difference between going to your GL carrier and saying, okay, defend this claim, or going to your cyber carrier and knowing that they have the right attorneys, the right staff, the right acumen, the right service providers, the right relationships to handle the claim efficiently. So I think that's sort of the big takeaway from that.
I've been waiting 15 years for this stuff to come around. So,
if I can add something to that, for the cost of the premium, especially for a firm like ours or any professional service firm, the business interruption piece that you're able to get from the policy really helps us who run the firm sleep better at night, because if we were to go down for any reason, our first-party claims and what we're covered for in a business interruption, in addition to the client base that we maintain and all of the PII, PCI, PHI that we host, store, and transmit in our daily practice, it's critical for us and anybody who does the type of work that we do to have that coverage. And I think if you look more expansively across your potential insured base, there are many areas that you could persuade them need to be covered, and under traditional coverage policies they may not be, but cyber is becoming more tailored specifically to address those consequences of a breach of both first party and third party.
and a lot of markets now are starting to tailor their base forms to certain sectors. They're not really changing the policy dramatically. It looks a little different. It says lawyers, cyber, accountant, cyber, but the policies are pretty much all the same. It's just the way of marketing. But that marketing feature is out there, and if you're trying to sell it to your client as a broker, you can show them, look, this is intended for you in your sector.
So I'd like to change the direction of the material just a little bit. We're going to talk about the other aspect of cyber creep and how it's affecting brokers and insurers in terms of what has the notion of cyber as it's changing done to the marketplace. How is the technology associated with cyber risk creeping into our underwriting process, our insurance and reinsurance process. So I think that one way to start this is is talk a little bit about something I noticed the other day. I was recently reviewing several of my past presentations on cyber. And what I noticed is every year my definition of cyber risk, cyber insurance changes. And it's been evolving year to year. I've watched it over the decade. And all of a sudden I looked and where am I now? I'm talking about cyber risk as the interconnectedness of data and systems. And it's really about a systemic risk issue for us. It's not just about cyber coverage, it's breach of data, but it's a larger issue. And part of what's happening now is when we start taking a look at from an underwriting perspective or a broker's perspective of looking at clients or looking at accounts that are coming across the underwriter's desk, we're seeing just how complex the interconnectedness of data and systems has become and how difficult it now is to understand without a lot of empirical loss data exactly, or a lot of underwriting data to find out exactly what is going on, how to put up terms, how to price for terms, and how to create resilient, let's say, underwriting operations to maintain and to continue to ensure cyber risk as it begins to grow. So it's not only an issue of where is cyber risk creeping into other lines of coverage, which also is included in the discussion, but how big is really the aggregation issue? Cyber policies, non-cyber policies, interconnected businesses, and do we have enough data to even understand what we're looking at, and do we have enough limits out there or enough understanding to continue in the marketplace? So I'd like to bring the first question on that to Jason and talk a little bit about cloud providers. And I'm going to follow up each one of these questions with, so what do we do about it? Okay. So as a cyber underwriter, what are the biggest concerns you have related to cloud and aggregation?
So aggregation is the scariest term in the insurance industry, right? So we look at, I like to compare cyber to two different types of coverage, property coverage and crime coverage. Property coverage because carriers have gotten a lot of information about the weather, and we know where the wind blows now. And we have complicated algorithms about where we write business in the coast of Florida and where we don't want to write business, and we don't want to aggregate as much limit as we can in those areas. We're very good about having that knowledge. Well, no one knows where the wind's blowing in cyber, right? You could have a loss tomorrow on any one of your accounts, and you don't really know how that works. So I think we're in the infancy as an industry of figuring out that aggregation, where the wind's blowing, and how we handle that holistically. So there's two types of aggregation that we worry about, and I'll give you a bonus one as well. But the first is triggering multiple cyber policies. That's the cloud, right? Or Anthem, or the one that I'm actually most concerned about is a little company called Fiserv that has like 85% of the banks in the country. So those kinds of issues are the things that we look at from a high level within the carrier, right? So we talk about, okay, if this cloud goes down, Amazon is the world's largest cloud provider. Any of the carriers here, we can pay a $10 million loss, $20 million, $50 million loss. When you start talking about maybe we have 1,000 insureds that use Amazon Cloud, and each one of them has $1 million limit, the $1 billion loss is the thing that we're concerned about that keeps us up at night. So, we try to figure out a way to track that. I talk about a balancing act of information with our broker and agency partners. We would love to get a 30-page application on all of our insureds, and exactly who they use as vendors and what they do on this, and this. The brokers in the room, can we get away with a 30-page application on all of our coverage? No, right? So that's not a competitive issue. Or it's a competitive issue, and it's not competitive in the market to get that much information. So you have to balance what information you're getting and how you use it. So I think we're still in the early stages of figuring that out. And there's actually third parties that are now gathering external data that are able to show some level of aggregation across your book by showing, okay, we think that they're sending data here, so that must mean they use this Amazon data center. So we can start to build those models, but that's still very early on in the stage. The second place is where we see aggregation is, like we talked about before, the same event hitting multiple policies, types of policies. So if you write multiple lines of management liability, let's say for a Blue Cross Blue Shield entity, well, now you get hit on the D&O, the E&O, the fiduciary. There was a recent case that brought in fiduciary defense coverage on a database claim because it was a ESOP. So you add up the limits that you put up on those different lines of business on one account, and now you start to get concerned on that too. So that's really the two areas we are concerned with. And then the third is we talked about yesterday a little bit was cyber creeping into like auto with the Jeep taking over the Jeep, or refrigerators at a grocery store being hacked and shutting down, and you lose all your groceries. That kind of creeping into the property, the auto, that kind of space. So we look at that creep as well.
Well, let me ask you this, Paul. Maybe you know the answer. It won't deal with clouds, but a non-accumulation of endorsement, if you're writing different lines for the same insured, or a pyramiding of limits endorsement, wouldn't that get around the accumulation issue a little bit?
Well, it depends. I mean, if you provide all the lines of coverage, or let's say all the professional coverages to a certain policyholder, one notion might be you could add an exclusionary endorsement to put all the cyber risk into one space. But
So that comes down to competition too, right? I mean, we would love if we write a large limit cyber policies and a D&O policy. Hey, on the D&O, do you mind if we tie in the limit? So if we have a single event, we only have one limit exposed.
Yeah, good luck with
Would
that,
you sell that? Yeah.
No,
So
no, never.
let's try that next time.
But I mean,
Yeah.
but if the industry moved in that direction, it's like the airlines. One airline raises rates and another airline follows. If somebody starts trying to move it, it may be a way to deal with the single policyholder accumulation issue. It wouldn't deal with the cloud provider or the vendor type of situation.
Yeah, I think you said it best before, is that no one wants to be that first one out there because it's not impacting the cyber book. Now you're impacting your existing D&O, E&O accounts that you're going to non-renew there because you tied in the limit.
So I think in some ways the market responds in the way underwriters have always responded, right? We don't like a box, so we change the way the box looks. We make it smaller, we shift it, we go for a different class of business, we go for a different revenue threshold. But we don't get to that level of creativity that says, okay, maybe we need to change the way we do business by looking at things that we should be doing differently. Does that sound consistent with your thoughts?
I mean, insurance is very reactionary, right? It's very slow, and so typically I don't see that much changing until there's an actual issue. And so that kind of takes us to one of the next things that we were kind of talking about, which is vendor risk. And I think vendor risk is really the elephant in the room, or the emperor has no clothes and no one's paying attention to this. And we talk about it. It's kind of cloud as part of a vendor risk, but I mean, Target was a classic example. Right? Does anyone heard of who was the Fazio Mechanical Services was the vendor that caused that entire breach, essentially? And so I think from a carrier perspective and even a brokerage perspective, I look at it and think, as much as we're talking about the data you can take, I think carriers are asking 100 questions on an application. The majority of them are not doing anything with that data right now. It's in a PDF, in a digital file, and they're not taking advantage of big data, right? Insurance is still so slow to move into actually taking advantage of that technology. And so if you think about it in, say, a small business scenario, how many small businesses are using a service like Dropbox or Box? Probably more than half. Maybe it's less. But if you think about that across the industry, that would be my biggest concern is, as a carrier, you don't necessarily even know how many of your clients are using that vendor. And that's the scenario of having one issue at one vendor trigger multiple policies. And then, as an underwriter, you can't necessarily underwrite the vendor's controls. And if you're not even tracking who the vendors are across your book, it becomes even more complicated. So I think as an industry, and if I were sitting on the carrier side still, that would be the biggest focus I would have, is trying to tackle that issue of actually tracking the data. But again, it becomes uncompetitive to ask for 80 questions on a small business app where some of them ask 5. And so they're definitely not tracking that across the book of business.
So I could think of two things to add. First, there's a recent letter that came out from the Lloyds marketplace that said that, and I'm going to put it in my own, paraphrase it, my understanding of how the letter was phrased was that if, to the extent that underwriters can't determine that cyber coverage is not part of a coverage of a blended policy, the assumption is going to be made that it is included in the policy, and therefore the capital requirements for those participating in the Lloyd's marketplace need to increase accordingly. So at least there is some recognition that there's cyber risk, and this is sort of on the periphery. The other thing to talk about is RMS, the modeling company, is now working with Cambridge University and a number of let's say, Lloyd's insurers and other insurers in the U.S. as well, to try to identify the key attributes associated with exposure tracking and start to make those requirements as part of the submissions in the Lloyd's marketplace. Rather than just a random assumption of is there risk or is there not risk, they're starting to look at additional attributes that can make their way through the process as tracking exposure sets. So when we talk about cloud providers and vendor risk, we're talking about trying to get that exposure level data into our underwriters' hands, into use, but I think we're just still a long time away from actually making that practical due to competition. Is that accurate?
Yeah.
Yeah,
Go
so
on.
I would say that absolutely is accurate. So if you look at the distribution of a carrier's book from a size standpoint, right? The small shops, you can maybe ask them, okay, which vendors do you use? And maybe they use 3, right? They'll have Dropbox, they'll have PayPal, and something else. But then you start going up the scale and size, and companies use a lot of vendors, and they don't know. The risk manager who's filling out the app doesn't know all the vendors. You have to go to a lot of people in the company to figure out which vendors they use, how much they use that data, right? So you'd want to know not just have they ever used Amazon's cloud, but how much, what data do they put in that cloud, right? Do they put PHI, PCI? Do they just store their own corporate data, something like that? So it becomes a more complicated question than just asking which vendors are used, because first of all, there's a lot of vendors, and second of all, it depends on what you use them for. So then you start getting into a lot of questions that they have a problem asking, and now you get to the competitive underwriting situation where they're not going to answer those questions. So we start to look at, I mentioned before, external sources, trying to figure out that from an external site that can look at where data is flowing through public available channels and try to figure out aggregation in that way, rather than asking all of our insureds about all of their vendors, because I think that's cumbersome.
Do you think any of these vendors are getting traction in the insurance marketplace?
I think they're trying to. They certainly are. There's certainly, I'm sure they're ones that are here today. So as those models get better, then carriers will start to look at that data a little bit better, and they'll incorporate that into the actuarial data. One thing we haven't hit on yet is the lack of claim data historically. That's why I compare it to crime. Crime has been around for 100 years, and we have an immense amount of data on crime claims. But cyber claims there's been claims for 10 years, so there's not enough historical significance to assign any weight behind the rate plans. So as we get more external data and internal claim data, that will start to change. We'll get better at modeling.
Let's talk a little bit about reinsurance and clash coverage. So what are your thoughts about why the pricing in the insurance marketplace is going up? Is it driven by reinsurance? Is it driven by fear of the aggregation exposure across multiple lines of business? Are you aware of how reinsurers might be responding to requests around clash coverage? What do you see in the market right now?
Go with that.
You can go.
So on a reinsurance basis, the only thing they care about is aggregation. So they want to look at what they talk to us about and others in the industry is what we do around this very question we're talking about. How we manage our aggregation so they can manage their aggregation. They are particularly interestingly, in business interruption. They don't want to have some huge event on a national scale wipe out a lot of first-party coverage, and they're very concerned about that. But so I wouldn't say that the reinsurance is driving the pricing in the cyber industry. I'd say that's more deal with the losses that we're seeing in the industry. So in certain segments, we're seeing price increase, healthcare, financial services, retail, because we're paying significant losses. I don't think necessarily because of the reinsurance. But reinsurance is simply a vehicle for carriers to spread that risk even further than we have across our pool of business. And each carrier can do that according to their own business practices. But the reinsurers themselves are nervous about cyber just because it hasn't happened yet. Right? Everyone, we talk about these huge events that could cut through many, many policies, and it hasn't happened. So we don't know what it looks like. Is it going to be really, really bad like some people think, or is it going to be just kind of bad? So and they're worried about it being really, really bad, and that's now that's the $1 billion loss instead of the $100 million loss. So that uncertainty leads them to price it a certain way.
Is there any empirical data out there? I mean, I know that we've got a wonderful claim study that Net Diligence puts out for us that say underwriting companies participate in, but how much is out there beside that?
Not a lot. There are other people out there that have some of that information. Just to add to the reinsurance discussion, I think another thing that constantly kind of came up in my previous days on the carrier side was franchisee risk, which was one of the other things we were talking about as far as aggregation. And from a brokerage perspective, that can be difficult to place franchisees, especially if you had a franchise that was actually hit. So an example would be Dairy Queen. Dairy Queen had a breach, and we had somebody had 19 Dairy Queens, and we quoted cyber from 15 different carriers. They said it was too expensive. Dairy Queen had a breach. His locations were not affected, and within a few days of that, the request was to revisit that proposal, and we had 15 declinations. And some of that is driven on the reinsurance end of that worry of having multiple insureds triggered in one place, because a lot of those risks are not Dairy Queen Los Angeles. They are some sort of capital company with a nebulous name that wouldn't let you know from the name of it that these are all related. And so that was something that I found came up on the reinsurance end that I don't know has necessarily been fully addressed as well.
How would you recommend handling something like that, the franchisor coverage issue?
I think, it raises a few different issues. You have franchisor coverage. Often the franchisees don't want to be under the franchisor's policy. They want their own policy. There's an issue of trying to place one large program for them with multiple limits, individual limits for different locations with a total cap. Carriers typically want to cap this one way or the other so that they're not triggering all these different policies, but a lot of the end franchisees don't want to be paying their limits going to somebody else in their group having a claim, and then they're essentially paying for it. So that creates a lot of complications. It's certainly an uphill battle for franchisees from that perspective. Usually the franchisor is pretty well protected, but the franchisee is at the mercy of using a franchisor's system, having no real control over it, and then just trying to get a policy as a backstop. And then on the carrier side, from a brokerage perspective, it can be complex just trying to place it when a carrier doesn't want to be on the hook for multiple.
So, I have to ask, is anybody out there doing that well? I know Axis isn't. We're not a great market for franchisees and franchisors, but who's doing it well?
Is Travelers doing it well?
I think we face the same challenge that you mentioned, is that there'll be some XYZ Corp that owns 50 different Dairy Queens, and we have no way in our system to tell that they own 50 different Dairy Queens because they're called XYZ Corp in the system. So if we write something like a Dairy Queen on a corporate basis, and then write 50 different Dairy Queens, we don't know that. So I wouldn't say we're tracking that well.
Yeah, I don't know that it's tracked well. I think it's hit or miss on what carriers may be better at it or not, and I think it will vary by which sub-vertical they're in. Whether it's small retail, whether it's healthcare, that would change on who might be better for it.
I think we're just going to have one more question, then I'm going to ask for some closing comments by our panel participants. So this is a question for Brian, and it really goes to policyholders and specifically clients. How does the cyber aggregation affect clients? What are you seeing in terms of what the marketplace is doing that is causing issues for your clients?
I think that the kind of couple things that jump to mind with that from a pure client perspective is kind of touching on franchisors have a bit of franchisees have an uphill battle potentially. But it's really a changing, the market is in such flux and the appetites are changing so quickly that is a challenge for the clients because they can't understand why XYZ carrier who quoted their account last year doesn't want to quote this year. An example would be a healthcare account, a Blue Cross and Blue Shield that we have that we've written. They wanted to go to market. We go to market, and the accounts that were most aggressive on them last year declined this year. And the reason was we have too much healthcare, just a blanket reason. So that the clients face a lot of uncertainty. And it's tough to explain that to them. And you can go through the process and give them the entire history. But for them, it's very strange to see that change so quickly. And so that's, I think from a client perspective, they're faced with a lot of questions from the underwriting perspective, and then they're faced with a variety of changing appetites within the industry.
So perhaps, I mean, I'm just going to throw this to Rick and Jack, so perhaps that's the argument that comes full circle, that if the insurance marketplace claims that we're selling the cyber insurance, it's great, but we're so fickle that year to year we can't decide what class of business we like, what class of business we don't like, where we see aggregation, start to pull the plug on renewal business. Maybe the argument is to find coverage in the GL and the professional policies and just to litigate with the insurance companies. Being devil's advocate, but jump on that one.
Well, I think that the model isn't broken, but the model is in disrepair. And I think that as more capital comes in, private equity, you're going to start seeing alternative methods. I think you're going to see more captives and cells. I think that traditional insurance really does not fit this model, just because of the way it is. So it's going to take a lot more hits. It's going to take a lot more underwriters pulling out of the market before somebody has the guts to be creative and throw the money into these other vehicles that I think are going to be the future of the cyber world. I don't think traditional insurance products are it.
Yeah, I'd agree with that, and I think that where we all probably abhor regulation unless it's necessary, I think we're going to see some favorable legislation which will answer some of the questions. There's a lot of discussion in Washington right now on how to tailor some cyber excess protection from the government side, much like the Safety Act, and there's got to be some government help, and I think in exchange for that, that's when you're going to get into the sharing of information so that the government can quantify risk as well, because it is such an industry changer. And the thing that alarms me, and I think being in Washington, what we hear so often is, what if 9/11 was cyber-induced? What if a major healthcare or hospital breach was cyber-induced and it resulted in mass consequences to patients? Whatever your imagination can run with, I think we're experiencing and recognizing in Washington that could happen. So the legislators are trying to get out in front of that and figure out how they can contribute, and I think they want to contribute in a positive way. So between the insurance industry and the federal government, I think we're going to get a backstop sooner rather than later.
Yeah, two things I want to add. I think you're right. We need a TRIA-type backstop, which you're going to see at some point when Congress can agree on something. So my kid's lifetime, maybe. But I think the second part of that is that as the underwriters start looking at this, they need to start aggregating their data collectively, just like the government is trying to get commercial industries and retailers to collectively exchange information about cyber threats and cyber risks. I think the insurance industry needs to do that, so that way they can get a better understanding. I think all the models in the world isn't going to get it done if you don't have the right data, garbage in, garbage out.
Yeah, just building on Jack's comments too, is I think one thing that carriers are cognizant of and concerned with is the expansion of cyber coverage, right? So we don't want to see cyber eventually become an all-risk coverage that covers everything from the data privacy to the business interruption to now the Jeep takeovers and the grocery store spoilage and the hospital, hacking your pacemakers and patients dying. We definitely don't want cyber to become the holistic coverage for all of that. So we talk about how cyber impacts coverage across the book of business, all of our lines of coverage, and as we see more exposures like those, the industry has to tackle how we cover those, not just as from a cyber insurance perspective.
Thank you. Let's do some closing remarks, and I'd like to start with Brian all the way over on the other.
I think for me, certainly from a broker's perspective, I would like to certainly see a little bit more in the vendor space of carriers getting a little bit better handle on it, because nothing worse will be is when there is a vendor issue that affects multiple policyholders and then everyone reacts, and it will create complete chaos on our end on dealing with new business or renewals. And so certainly that's a concern for me, that one issue is going to cause a reaction across the market and drastically affect every single account from just a day-to-day handling perspective. So I would certainly love to see some, taking advantage of big data within insurance and moving a little bit quicker on that, so that we're not reacting and trying to get a little bit ahead of it. I think that's probably the biggest concern I would have.
Jason?
So insurance is slow, and cyber moves fast. So we've been forced to react in that space. The technology is evolving so quickly that it outstrips the coverage. So we're talking about GL forms that were written in the 70s trying to cover things that are happening today. Well, cyber policies that were written 3 years ago are now out of date because the technology changes so quickly. So I think that part has been a challenge from an industry perspective, is staying on top of the evolving technologies and risks. So as we get more, again, big data, we try to use big data as much as we can, and as we get more of that data and that becomes more available, we'll get a better handle on both the aggregation and the modeling of the pricing.
Just wait for the all-risk policy. I haven't seen one, but I know it's going to be there in the next year or two.
Keep
because,
waiting, Rick. Keep
You
waiting.
know what? What you guys are doing is almost tantamount to all risk, because who's denying claims?
It's free and it's all risk. That's what you should take away from the panel.
It's a good
Go
point.
to Rick for all your insurance needs.
I actually got an email this morning looking for an all-risk cyber policy.
It's,
But you're right.
somebody's going to do it. There's not as much technical underwriting, and there's a lot more technical claims handling, but